You know, I get asked all the time, what is the best way to design an infinite banking policy for real estate? Well, it's like there's one simple way, right? No, there's a lot of different ways you can do this because there's a lot of different things you can do in real estate. I mean, you could be flipping real estate, you could be buying rentals, you could be lending money on real estate through private money clubs. So each one of those different solutions, those problems that we need to solve, require a different design. And also, we got to factor in, how are you putting money into the policy? Are you doing a dump in and premium deposits or just premium deposits? All of these are the things we have to consider, and all of those are what we're going to cover today. We're going to talk about the best ways to design your infinite banking policy for all the different types of real estate. And not only that, I'm going to show you how much money you're losing to the traditional banks and how you can take back the money you're giving away to all the mortgages and all the bank loans you have. And all you need to do is change one thing and add one step, because that is going to put you back in control of your money. So that's what we're going to talk about: real estate, infinite banking, and you. My name's Chris Naugle. This is What Now? What's next for real estate in your life? Now, before we dive into what the best design for your infinite banking policy is, we got to talk a little bit about this real estate thing. And, you know, we're going into a new year, 2025. What is real estate going to look like? I mean, we got a new president, we got a new economy shaping up or shaping down. What is in store for real estate? Well, we did some research for you. So check this out. Right here, Zillow is saying a couple things. Number one, they're saying that interest rates are going to go down, then back up, and then down again. Now, I don't know about that. I definitely know interest rates are going to go down. But the second thing Zillow is saying is demand. Demand is going to be strong. There are a lot of buyers out there, but a lot of the buyers were just priced out of the market. They weren't just priced out because the price of real estate went up, up, and up, but they were priced out because interest rates were so high. So if interest rates are coming down, every point interest rates go down, that opens up a whole bunch of new buyers, and that just might be you. But not only that, Dave Ramsey's saying the same thing. Now, Dave Ramsey, he's not always my favorite, but hey, I figured he's got something up there. Dave Ramsey's saying the same thing. Interest rates are going to go down, which is going to create more demand, which is going to create pricing going up. Now, I know you don't want prices to go up, but it might just happen. I personally think it's going to be state specific and area specific in terms of where prices go up and where prices go down. You're seeing that shape up right now, so I agree with what Dave Ramsey's saying here. Let me just give you a little advice. You know, if you're looking for a house, you're probably like so many others. You find one and there's a bidding war and you lose it because it just goes crazy. And it doesn't just go crazy, it seems like everybody's coming in with cash offers. Are they really coming in with cash offers? Well, that's something you're going to learn a lot about in today's video, because the cash offers that you hear that they're coming in with are not really that they just have a bunch of cash. They are coming in saying they're going to pay cash, but it's not cash. It's sometimes a loan from a private lender, like a loan from someone in private money club. So when you hear all these buyers coming in with cash offers, yes, some of them are cash offers, some of them their mommy and daddy are giving them the money, but a lot of them are just putting on the contract that they're a cash buyer when they're really not. They're just not borrowing money from the traditional bank. So going forward, when you're looking to buy a house, get creative, play the game. Do what they're doing and go to privatemoneyclub.com and buy a house in a company name. Even though it's your primary residence, look at buying it in your company name. That opens you up for a lot more funding options from the private lending community. Oh, sneaky, sneaky.
Sneaky, sneaky, sir.
And then you probably have heard of Grant Cardone. Well, he's betting big on real estate. I don't fully agree with everything Grant's doing, but he may just be onto something in this new administration. And last but not least, check this article out: the top places to buy real estate. I bet you didn't think Boise, Idaho was going to make the list. Not only that, how about Indianapolis? Well, If you're not looking to buy houses in those two areas, there's lots of other great places, but you might want to do some research. So let's dive into what it looks like for getting started in real estate. And I got a good story on this. Hey guys, real quick, I need to ask you to do something. You see that little button right there? That one, it says subscribe. Click that button, and also right above, there's a little bell. I need you to smash that bell so that you're notified every single time I put new content out, and that is all I'm asking for. You know, when you're looking at real estate, there's all sorts of different ways you can buy real estate. Maybe you're looking for your first home, your first flip. Maybe you're looking for your first rental or house hack, I don't know. But you're gonna have to figure the money piece out. And most people, what they will do is go to the traditional bank. And that's what I really wanna talk about. I wanna talk about how much money you're actually paying the bank. But let me take a step back. I wanna talk to you about one of my first real estate experiences. You see, I watched a TV show, and in 24 minutes, they flipped a house and made 40 grand. I'm like, sign me up, I'm gonna flip my first house. So I got a hold of my realtor, Anas. She found me a house out in this little quaint neighborhood in Gasport, New York. None of you know where that place is, but it was a dilapidated farmhouse, and I'm like, I got this. Just so you know, I didn't have this, but how I funded the deal was where I first made the mistake. You see, up to that point, all I'd known about mortgages is that you could go buy a house, get a Fannie or Freddie loan, and only have to come out of pocket 5%, because that's how I bought my first house. So when I was buying this first flip, I thought this is the same. I had enough money for roughly 5% down and a little bit for rehab. I was just gonna figure it out. But I remember as I got into the deal, put it under contract, the contract went hard, which means my deposit, which I think it was like 2 grand, if I walked away from the deal, it was done. But the bank comes back to me with their proposal. And I look at it and I'm like, something's not right. They want 20% down. You know, I called the banker and I said, hey, yeah, I think you guys messed the math up here. Yeah, you know, on this mortgage we're doing for this flip, yeah, you got it down that I got to put 20% down. I don't have 20% to put down. Oh, it's, yeah, non-owner. Yeah, I'm not living there. No. Okay, so it's non-owner occupied. It's commercial. Oh, crap. I do have to put that 20% down. Okay, great, thanks. That was the call. I literally did not have the 20%. So back then, what I did is I exhausted all my options. I emptied my bank accounts, I went into my 401k and took a loan, and I even took a loan from my life insurance policy just to close on this house. So when I closed on it, all the money I had for rehab was gone. So rehab literally was paycheck by paycheck, credit card by credit card, and that's how I did my first flip. Please, folks, don't do it that way. I'm gonna show you a much better way. If you're doing your first flip, go to privatemoneyclub.com and you will find tons of people who have money and they wanna make more money by lending it to people like you. But what you gotta understand is a lot of the folks on Private Money Club are lending from their infinite banking concepts policy. That's right, their machine is a specially designed and engineered whole life, and that's what I wanna go into next. I wanna show you exactly what it looks like, exactly what the best design would be. We're gonna use some numbers, folks. These might be bigger numbers, but I can show smaller numbers, but I gotta start somewhere. So let's dive into what is the best design for the infinite banking concepts. All right, so let's get into how to design an IBC policy for real estate. We're gonna look at several different things, but we're also going to look at the mathematics behind this because this is a big mistake. I did another video back a long time ago that was similar, and people got so hung up in the math thinking they were right. Listen, math can be done for different things to solve different problems, and that's what you gotta understand. So real quick, we're gonna talk about 2 types of returns. Number 1, cash on cash return. So what is cash on cash? It's simple. If I put 10 grand into some type of savings or investment, how much money did I make at the end of the year on just that 10 grand? Nothing to do with prior years or future years, just that year. That would be cash on cash return. So for real estate investors, usually that's the return they look at. And for people doing infinite banking, that's the return we use. But a lot of people want to get hung up on cumulative returns. So what is a cumulative return? Well, it's like your 401k. every year you put 10 grand into your 401k, and after 20 years you add up, all right, I put $200,000 in, how much do I have? I have $300,000. How much of a return did I make? That's cumulative. Now that's great. I like cumulative return, but you only would use cumulative if you're putting money somewhere and leaving it sit. That isn't what we're doing for the infinite banking concept. What we're doing for the infinite banking concepts is we're putting money in, finding somewhere like real estate for that money to go earn a higher return, taking that return that we earn on our money, rolling it back into the place where it came from, which is the policy, which we're going to assume the policy is your private banking system. That's what we're gonna do. So how do we maximize your return for your specific needs? Think about real estate. Real estate requires money for lots of things. So in order to pay cash for a property, we gotta save up money. In order to pay cash for the renovations, we gotta save up money. There are only two ways you're gonna do it. Either you're going to fund your real estate or you're gonna borrow money from someone or some institution to fund your real estate. Comprende? That's what we gotta understand. So let's dive into how these policies are designed. Now, in order to do that, I always talk about specially designed and engineered whole life insurance policies from a mutually owned company that pays dividends. That's all we're doing. Boring, right? And Dave Ramsey and Susie Orman say whole life is the worst place you can put your money. I would agree with them if you're talking about an off-the-shelf whole life. So what is an off-the-shelf whole life? Well, it's a policy that you buy for a death benefit. You're literally saying, hey, I need a $50,000 death benefit. The insurance agent goes back, runs their little calculation, says, all right, 50 grand is gonna cost you this much. And you're like, okay, that's kind of expensive, but all right, I need it for my whole life, so let's do that. How we're doing this is we're starting with how much do you want to save? Because remember, how we do this is we change one thing, and that's where your savings goes first. The savings that you are going to use for real estate. That's what we're talking about. So all we're gonna do is we're not gonna save in a bank account or a brokerage account. We're gonna change where the money goes first, and we're gonna put it into a specially designed policy. Now there's a big difference because when we design these policies, we're not designing them to maximize death benefit. We are designing them to maximize cash value. Cashola, money you can use immediately in the first 30 days because, hey, when a real estate deal shows up at your door, you need liquidity of that money right then. So that's what we got to do. And we want to design it to be the lowest cost and the highest cash growth. So when we design these, we design them the complete opposite way that a normal whole life is designed. So we don't start with a death benefit, we start with your savings. Now, again, this is full disclaimer, I'm just doing this as an example, but we're gonna talk about somebody that's buying some big real estate projects. They've been saving money for a long time. They got money in investments, they got money in bank accounts. Let's just assume that they've saved up $1 million. Why am I using $1 million? I know I'm gonna get feedback in the comments, and hey, if you got something to say, put it down in the comment. The reason I'm using $1 million is the last time I did this, I did it with a lot less money. And I had a bunch of people say, you can't buy real estate in our area for that much. Great. So now we're gonna start with somebody that saved $1 million. They got that money in their right pocket. The right pocket represents the bank account where the money is. So what we're gonna do is we're gonna change where that money goes. We're gonna take it out of the bank, okay? And we're gonna move it and we're gonna put it into our bank, the left pocket. So it went from the right pocket to the left pocket. Why? Well, let's just say you found yourself a better place for your money to go where it can earn a higher guaranteed interest rate. It has less fluctuations in the guaranteed interest rate, meaning the interest rate never changes from the day you start. It pays you dividends every year, and the interest and dividends grow tax-free in my left pocket. When it was in my right pocket, I had an interest rate, but the bank could change that interest rate anytime. Plus, the interest I earned in my right pocket was taxed every year. And if I died, that money would have to go through probate because it was a probatable account. Now, in the left pocket, no probate, tax-free growth if designed right, and it grows with interest and dividends in a tax-free environment. Listen, it isn't gonna get much better than that. Plus, if you die tomorrow, in your right pocket, the bank, your family gets only what's in there after it goes through probate. If you die with the money that is in the left pocket, the specially designed whole life, there's a death benefit paid out to your family, tax-free, no probate. So let's dive into that scenario. The person has $1 million, as you can see here. So we got $1 million that they start with. And this money was in a traditional bank, so they change and put that money into the policy. It's called a dump-in. So we got a $1 million dump-in, okay? Represented right here. Now, in order to do $1 million dump-in, you have to be saving money. In order for the internal cash value to grow tax-free in these policies, they have to fall into what's called the MEC 7 pay rule. It's an IRS rule that basically proves that the policy is life insurance and designed for life insurance. So how we have to do that is when we're gonna dump in $1 million, we basically have to put the death benefit on the policy that will support $1 million dump-in, which in this case is $13,525,470, shown right there. Now, again, your policy might look different than this one, so full transparency and disclaimer, this is based on a 46-year-old that saved up $1 million and can save at least $100,000 a year. Now, I know those are big numbers. If that's not you, that's fine. Start subtracting zeros. The math will be the same, it just will be smaller dollar amounts. Fair enough? So that's what we're talking about here. To design it properly, you notice how that death benefit's kind of weird? You know, you don't go to your insurance agent and be like, hey, Mr. or Mrs. Insurance Agent, give me a $13,525,470 death benefit. Is that how you start it? No. You'd be like, hey, what's it gonna cost for a $13 million death benefit if you were buying death benefit? But you're not. You're designing a policy to maximize cash value growth. So $13,525,470 represents the absolute minimum death benefit that we need for the MEC 7 pay rule, the IRS rules, to be called life insurance. Fair enough? And now, every year, why are we saving $100,000? Well, it's because we have to. If we're dumping $1 million in, we gotta have a certain amount of premium deposits going in each year for at least 7 years. So I want you to look at this real quick. We dump $1 million in, we're gonna save $100,000 a year. It's actually $100,002. And then in the 8th year, it's gonna drop to $83,691. Why does it drop? Well, if we come over here, you can see there's a big negative on the death benefit. The death benefit drops by $10,595,626. How many of you can guess why we're losing $10 million plus in death benefit? Term insurance. We used Dave Ramsey's term insurance. We didn't actually use his term insurance, but it sounded good. We used a term rider on the policy for 7 years because the MEC 7 pay rule says we need death benefit to match the amount of premium deposits for a period of 7 years. You can look that up. I'm not getting deep into the MEC rules, but that's why. We don't need the term insurance on the policy after the 7th year. So in the 8th year, we have dropped the term, which reduces the amount of funding we're going to put into the policy now to $83,691. Okay, stay with me. I'm giving you a lot of numbers, but I'm going to bring it full circle. So now we're doing $83,691 until the 10th year. What happens in the 10th year? Okay, now we're going to pause and I'm going to show you how these are designed. First thing, you now understand we design them around a premium deposit, not a death benefit. The only reason we have a death benefit on it is because we need to satisfy the IRS rule called the MEC 7 pay rule. Now, when we design these, if you can focus on this and just think of this as we're building a rocket ship, okay? You can think of Elon Musk however you want. We're building a rocket ship to go to space. In space, well, we're not going to space, but we're gonna build a lot of cash. But that IBC rocket we're designing has 2 components, just like a rocket that Elon Musk is designing. Number 1, it's got a fuselage. We call that the base, okay? So this right here, your main part of your rocket is the base. The base represents what you would get if you went to a regular insurance agent and they just designed you a policy. That would be the base. It is not efficient in the beginning. As you get into the years, like after year 10, it's very efficient, but in the early years, it is not efficient, it does not provide a lot of cash value, and it stunts the growth. So how much money do you want going to the base? As little as possible, right? Right. Where do you want the money going? Well, you want the money going just like those rockets that you've seen blast off to the boosters, because the boosters are the horsepower, right? And we're gonna call these PUAs. And as you know with a regular rocket, when a rocket blasts off, these boosters do all the work. They put a ton of thrust out, and that thrust gets this rocket into space. When it punches through our atmosphere, what happens to those booster rockets? They fall off, don't they? That's right. The booster rockets are no longer needed because now the base, the fuselage, is the most efficient part. So now, as we get to space, those rockets, those PUAs, fall to Earth and land on some barge that Elon Musk designed. But I'm just kidding. You get it? So we need the base to be designed for the policy to do what you want. Now, in this particular design, to dump $1 million in and $100,000 each year for a 46-year-old requires 70% of your premiums to go to the boosters. So 70% of this policy is being dumped into the paid up additions in the first 10 years. After that, all of your premium deposit, all $50,120, is going to the base. We get rid of the paid up additions because they are just not efficient anymore. And that's what we're doing. If you're gonna get into real estate and you wanna be your own bank, we need to design the most efficient design for your particular situation. Now, your particular situation might not be a 70-30. Yours might be an 80-20. It might be a 90-10. It might be a 60-40. It might even be a 50-50. You see, there are so many variables, but I don't need you to fully understand that. I got another video that I'll give you at the end, how to design an IBC policy for the banking policies. That video shows all the different designs, but what I want you to know, all I want you to know is for this particular client, this particular situation, which is a real estate situation, this client wanted to put $1 million in the first year, $100,000 in each year thereafter. The most efficient design that we built was a 70-30, okay? Now, what's right for this client might not be right for you, but for this example, that's what we're gonna use. So let me start showing you some of the numbers. Why would we use a specially designed whole life for real estate? Why wouldn't we just put it into a bank? Well, that's what we're gonna do now. We're gonna come over here and we're gonna focus on the cash value. And we're gonna focus on the bad first and then the good, okay? So when we dump this $1 million into this policy, we only have $917,570. 91.76% of the money we put into the policy is what's available. Let me pause. How many of you think that sucks? All of you should. Because you put $1 million in and you only have $917,570 in there. Why? Well, folks, if you remember, somebody's got to pay for that $13,525,470 death benefit, plus the commission. The commission was reduced in this design by about 70% because we put 70% into paid up additions. We didn't put 100% into the base because that would maximize our commission. We put 30% into the base, 70% into the PUAs, which reduced our compensation, okay? Because we're the agents that are putting this together for you, by roughly 70%. We had to take a 70% cut in pay to design it this way. Now, that's a bad thing, right? Hold on a second. What if you found a piece of real estate that you wanted to buy for $900,000, or you wanted to lend money on a piece of real estate in a first lien position for $900,000? That would be great, right? Because you have $900,000 available in cash value. So what we're going to do is we're going to take $900,000 out and we're going to go buy that piece of real estate. But how did we take that $900,000? Well, let's just think of how would you take it from a bank account? If you had $900,000 in the bank and you went and took $900,000 out, is the bank still paying you interest on the $900,000? No. In other words, if you had a bank account with 900 grand in it earning 4%, you take 900,000 out of the bank account to buy a piece of real estate, there's no money in your bank account, which means the bank is paying you nothing on that money. But you see, in the policy, what we are allowed to do is just like almost kind of like a line of credit. We're allowed to use up to our cash value, $917,000, but we don't need to use our money. The insurance company will advance us or loan us $900,000 from their general account. They have plenty of money, so they will loan that money to us. Right now, the interest rates are anywhere between 5 and 7% depending on the insurance company. But let's just focus on this particular one, which I believe is about 5.2%. So we can borrow money at 5.2% simple interest. Where did the money come from? You're right, the insurance company's general account. Does the insurance company care if we ever pay that money back while we're living? Not really. They would prefer you take a loan for 900 grand and never pay them back because that's income to them, that's interest to them. Where did the money come from? Your death benefit. You had $13 million in death benefit. So what they do is they subtract 900,000 from that 13,525 and they call it a day. When you die, if you never paid any of that 900,000 back, they paid 900,000 less in death benefit. So realistically, what you're using is you're getting an advance of your death benefit while you're living, up to and only up to the amount of cash value you have in the policy. Because the cash value represents collateral. You see, insurance companies aren't silly, just like private lenders aren't silly. When we lend money on your real estate deal, even if we take it from our policy, we want you to collateralize it with the property. And we want the property to be worth more than what we lend you, or at least the amount we lend you, right? Logical. Well, that's what the insurance company does. But what that allows you to do is that allows you to earn interest and dividends on all $917,570, even though we got to use $900,000 at an interest rate, which is probably lower than what you could ever borrow money from a bank for right now. So let's go over one more thing. If you got $917,570 in the bank, earning interest and dividends, but you got to pay 5.2, how much are you making? Well, in the first year, none. You're actually losing money. The first year you lost $82,432. That's how much you lost because you had to pay for a death benefit. So that sucks. Well, in order to figure that out, we got to continue down the path because we now have $900,000 out earning something in that real estate deal. Now let's just assume that that real estate deal is earning 6%. Okay, if that real estate deal is earning you 6% net, where's that 6% gonna go? Well, most of you would put it back into the bank account, but we're not gonna do that. We're gonna take the 6% you make on that real estate you just bought, and we're gonna put it back into the policy. But I'm not showing you the math on that, but that's just in theory how the infinite banking concepts work. Because what we wanna do is take the money you make and put it back into your banking system instead of putting it back into their banking system, because that just makes perfect sense. But let's go on to the next year. The next year, remember you were gonna put another $100,000 in the policy. So you put $100,000 in premium deposits in year 2. How much money do you have to use? Well, remember, we had $917,570 in the first year, but we took $900,000 out and we bought a house that's making 6%. That 6% is more than the cost of capital, so you're making a spread of roughly 80 basis points right there, okay? Now, the second year, that $100,000 you put into the policy, because of uninterrupted compounding interest on all of the money, now is worth $107,219. You literally made 7.22% cash on cash. Remember I said earlier, there's cash on cash and there's cumulative. We're gonna talk about both, but let's just talk about cash on cash. You put $100,000 in, you now have $107,219 to use, which is roughly 7.22% gain on the 100 you put in. Now, I know some of you are still struggling to figure this out, but listen, if you put money somewhere and every year you could use that money to go make more money, why would you ever just leave that money in the account? In other words, why would you do cumulative returns when you have access to the money and that money can go work at a higher rate? So if you made 7.22% and you lent 107 out, okay, so you bought the real estate, but the second year you take 107 and you lend that money out at 12%. So now the second year you did a private loan. All the money's out working, okay? You used all of it. So if you make 7.22% that year, cash on cash, and it costs you 5.2 to borrow that money, well, let's just do the math. So 7.22 minus 5.2 is about a 2% spread. you made 2% plus 12. So realistically, in the second year on that 107, you just found a way to make 2% more by just changing where your money went first. But see, here's the best part. Compounding interest doesn't stop. It keeps compounding the full amount. Your cash value in the second year was $1,024,789. That $1,024,789 is earning guaranteed interest plus dividends. With this insurance company, it works out to be 5.75. That is their dividend crediting rate. That is the gross dividend crediting rate that you'd be earning. It's not what you actually make because you got cost in the policy, but that's what you're making. So here, that's actually what you made. Net, net, net. In this third year, you put 100 in, you got $1,138,55 earning interest and dividends at that 5.75 crediting rate. But this year you make 13.26. So that rental that you bought in the first year for $900,000, you're going to do some renovations to it. So you take this $113,000, which is what the third year's 100 makes. That means you made $13,266 that year. That's 13.26%. Remember, you're making money on all of your money now. This money goes up here, and now it costs, or you're made 13.26 minus 5.2 was the cost of capital. See how your spread went up? Every year we do this, the spread is going to go up, up, and up. Why? Mathematics, folks. Compounding interest, but not just compounding interest. See, most of you know compounding interest by putting money somewhere and leaving it sit. I'm talking about uninterrupted compounding interest. Money that grows whether you use it or you leave it in there. But if you can make a spread, why would you ever leave it in there? Which is what I'm trying to show you with the cash on cash returns. But now let's just take a break because some of you all still want to see the cumulative return. So here we go. Let's go into the cumulative return. Even though that's not what we teach, that's not how we tell people to use these. We don't tell you to put money into the specially designed whole life and leave it sit there, but some people do. It is still a better place than a bank account to store your wealth and to store your capital. Because number one, you got protection for your family. You got this beautiful death benefit on there. Number two, it grows tax-free. Number three, it's protected against judgments and liens in most states. And number three, it bypasses probate. So you got a lot of features here inside the policy you don't have in a bank account. But the downside was we lose money cumulatively for the first 5 years. Look at this, 5 years. It took us 5 years to break even cumulatively. In other words, if I put 1 million in the first year, 100 the second year, 100 the third year, 100 the fourth year, and 100 the fifth year, how much money did I put in? Well, I put in $1.5 million, okay? So now I put 1.5 million in the fifth year. How much cash value do I have and how much did it grow? Well, here we go. We'll just draw a line right across. I put in 1.5, but my cash value in the sixth year is 1.52. So from a cumulative standpoint, it took 5 years, as you can see. 5 years, 1.5 million in premium deposits was put into the policy for you to break even because you had to pay for this big death benefit to protect your family and to provide a legacy when you're no longer here. Now, believe it or not, there are some folks out there that don't care about the death benefit. They obviously don't really care to leave a legacy for their loved ones, but I know that isn't any of you, and it's not the 16,000 plus clients that we've already done this for. And it's definitely not me because I care about the death benefit. But I also understand that I'm not doing this for immediate gratification. I'm doing this for lots of future wealth building. I love the idea that when I put money in, I could use that money and still earn interest on all of it. But I also love the idea that if I died and went on to heaven, there's a death benefit paid out to my family. And I also understand that death benefit has a cost, but that cost is outweighed by growth. And that's what you see here. By the sixth year, okay? By the sixth year, I have $1.52 million. I made, so right here, projected premium to cash, I made $20,000 on my money. Now the return in that year wouldn't be very much, and how I'd figure that out is I would just come over here and I would pull up a calculator and I would just say, all right, I made $20,402. Okay, that's how much I made right here. So you can all see that right there. Now divide that into the 1.5 million that we made in premium deposits. So what's my return? My return is just a smidgen over 1.3%. Not much. But hold on, is that really what you made? You made 1.3+% in this year, at the 6th year here, but we also made the money on this real estate because we used our money for that. We also made the interest on that private loan. We also got to use money to renovate the property, which would increase the returns in most cases. And I didn't even cover the last two because you had 119,000 there, 127 and 135 you could have used. Could you have lent that money out, bought more real estate with all of that? So what's the return on all those? I don't know, but you can use your imagination. But hold on, let's do one more cumulative return because I want you to see how this works. Let's go to year 10. We're gonna come down here 10 years in. So how much money did you put in 10 years? All right, so I took my calculator and all I did is I added up the premium deposits we put in for 10 years. We put in $1,851,085. Now remember, we're looking at the different returns. We're now talking about cumulative returns. How much money you put in over the course of time versus the return you make on that money. So how much money does our policy have? Well, in 10 years, our policy's cash value is $2,134,559. So what does that mean? That means we made $283,472 plus, remember we dropped the term, so now we have a death benefit of $4,227,775. So now let's do the numbers. If you take the $283,472 that we made over 10 years, so remember that's net gain, okay? Net means net of commissions, net of cost of insurance, net of policy service fee, which in this company is $100 a year. So we take that, we divide that into the total amount we put in, $1,851,085. What's our return? 15%, 15.31%. That's a cumulative return over 10 years. What's your cash on cash return in the 10th year? It gets silly. Your cash on cash return for that $83,691 you put in, you made $163,510 that year. That's a 95.37% cash on cash return. So if you were playing the infinite banking game and you were using the cash value every year to go make more money, buy more real estate, lend more money, do whatever you're gonna do, that would be the return you'd use. So then don't forget, you always gotta subtract the cost of capital, 5.2%. But even over here in 10 years, we made 15.31 off of that. Some of you would say that's not a good return. You could make more somewhere else, but you could not because there is no other way where you could make more than 15.31 because you're looking at this wrong. It's not that you couldn't make more than 15, but you made 15.31 plus whatever you made on the other side in real estate. You made 15.31 plus whatever the stocks made, plus whatever crypto made. It's not this or that, folks. It's this policy and whatever you're going to invest in. Remember, you get to use the cash value and still earn uninterrupted compounding interest. That's where people get this wrong. So it doesn't matter whether you use cumulative or cash on cash return. It all depends on how you're going to use the policy. And for all of you, your design might and more than likely will look different than this one. So your numbers will be different. But let us design that by watching the video in the bio and clicking the link to schedule a call so we can design your policy. But hold on, let me bring this thing full circle. Remember, the reason we're using the policy is, as far as I know, the only place we can put money and use that money without interrupting the compounding effect. Not only that, the insurance companies will allow us to use their money, the loan that we take from the insurance company, at a rate that's less than most banks are lending at. I don't know a single bank right now that is lending at 5.2%. The closest thing is a no-risk CV line of credit loan from a bank, and they're still charging 7%. 5.2 is less than 7. Anyway, we get to use our money. So if you really did this and every year you took this money out as loans and you loaned this out, bought real estate, kept doing it, funded marketing campaigns, whatever you did, you got to use all this money while it was still growing, while it was still earning these returns, as long as your policy is a non-direct recognition company, which those are the only ones we like to use, and you got yourself a death benefit for your family. Remember, these returns you're earning, the cumulative or the cash on cash, are the growth of your cash value. We call that the internal buildup of your cash value, which, because we designed it within the Max 7 pay rules, is tax-free. So what would your investments have to earn to make 15.31 net of taxes? A lot more. That's why the wealthy use this. That's why you should use this to buy your real estate. However, the worst thing is it takes time to build this up. So what most people do is fall victim to this. And this is what we're going to finish with. A lot of people will come to us and say, hey, Chris, why would I do this when I can borrow money from a bank in a 30-year mortgage? Now, what we did is we went on to a site, okay, and we looked at a 30-year fixed mortgage, 30-year fixed. And the best offer, perfect credit, perfect everything, was 6.01%. So what we did is we said, all right, let's run an amortization for that. If we wanted to borrow $410,000, 410 is the median home price of a house in this country right now. How much would it cost us? Well, all of you are thinking, well, duh, Chris, if it's a 6% mortgage, it's going to cost 6%. Wrong. Look at these numbers right here. So how much are you actually paying? You see, mortgages are amortized loans. That the banks are so smart, they've found a way to put all the interest in the first early years of that mortgage, meaning you're almost paying all the interest back to the bank in the early years, not the later years. You don't start making ground on the principal until much later. Look at these right here. Let's just focus on year 9. So year 9, your payments that you make to the bank are almost all interest. And if we go over here to that ratio, so what we do is we add up all the interest that you've paid and we divide it into the amount of the mortgage, which was 410. So that means 51% of every payment you made went to interest. That's almost like saying you paid 51% interest, although your mortgage says it was 6%. But you gave up 51% of all your mortgage payments to interest. Hold on, it gets even better. 14 years in, you gave up 75% of every payment to interest. And by the 19th year, you gave up 95% of every payment to interest. The math is right here, folks. You can see. And just look, principal and interest. Look at how much more you're giving to interest versus principal on this mortgage. Now, let me pose you one final thing. Now that you know how an amortization schedule works, imagine this. Imagine you saved up $410,000 in a policy like this, and you bought the house and you paid $410,000 for the house. And all you did is you just went and you just figured out exactly how much your mortgage payment would have been on this particular house, okay? Which would be $2,458.16. That's how much the mortgage would have been if you paid someone else's bank. But you don't. You take the loan from your bank. The $410,000 came from your bank's cash value. And then you make payments of $2,458.16 back to your policy every year, which are repaying the loan. And you do that at the exact same rate you would have paid to the bank. Now, remember those interest rates I gave you? Remember 9 years in, you gave 51% of every payment to interest. So their bank got 51% of all your money on that house you paid. In this scenario, how much money did you give to the bank? All of it, because you are the bank. And how much did it actually cost you? 5.2% or whatever your loan interest rate is with the insurance company. But that's simple interest, not amortized. It's the same amount. You see, there's a huge difference between simple interest and amortized interest and how it's calculated. What you're seeing here is how by you being the bank, you're paying yourself back the exact same amount you would have paid their bank, dollar for dollar, except for you keep the money and you earn uninterrupted compounding interest on all $410,000 that you spent on the house. So at the end of 30 years, you would have got all the money back for the house, plus all the interest you would have given away back. Is that a better place? Absolutely. You see, folks, when you're looking at this for real estate, the design matters, but it's your design that matters. I just used one example to show you how it works. Now let us design your policy. You know, I was once told there are 2 businesses you need to be in. One is the business that pays your bills, and number 2 is the business of being the bank. And that's what you just learned. But not only that, you learned it specifically for real estate. So now that you have all this information and all the know-how of exactly what you need to do to start the infinite banking concept, now the ball's in your court. What are you gonna do? So as you can see, it's time for you to become your own bank, because why are you giving up all this money to the traditional banks? That was insane, wasn't it? How much money you're giving up on traditional mortgages? Well, it's not just traditional mortgages. You're giving up control through money markets and CDs and high yield savings accounts. Stop that. You need to become the bank. Change where your money goes first. And now is the time where you got to make the decision. Is this the right path for you? Well, I can help you with that. In the description, there's a video. Watch that video and book a call with one of our money mentors where we can walk through your situation. Maybe you're a private lender, maybe you're a flipper, maybe you're wholesale, maybe you're sub to. It doesn't matter what you are, where we can design your policy the way you want for your unique situation. And last but not least, if you liked this video, you're gonna love this one right here, Max Cash Value. My name's Chris Naugle, and you just watched What Now, What's Next for you.